Why your dividend stocks might be slowly killing your portfolio. Let me paint you a picture. It's 2009. The market just crashed. A guy named Gary in Ohio is sitting at his kitchen table, staring at his brokerage account. He did everything right. He bought dividend stocks. He collected those checks. He felt safe. And then, his phone rings. It's his broker. 3 of his biggest dividend payers just slashed their payouts. His income dropped by 40% overnight. His stocks were down 55%. Gary thought dividends were his safety net. Instead, they became his trap. Here's the brutal truth nobody on the internet wants to tell you: most people chasing dividend income have no idea what they're actually doing. And that ignorance is costing them, sometimes everything. Today, we're going to fix that. What's up, everyone? Welcome back to the channel. Today we're doing a deep dive on dividend investing, but not the fluffy, feel-good version you've seen 100 times. We're going full reality check. We're going to talk about the stuff that actually matters: what dividends can do for you, what they can't, the traps that catch most beginners, and how to know whether dividend investing even makes sense for your life right now. No hype. No filler. Just the real stuff. Let's go. Okay, first things first. Let's talk about what a dividend actually is, because I promise you, a lot of people have this backwards. When a company makes money, it has a choice. It can reinvest that money back into the business, new products, new stores, hiring, research. Or it can hand some of that cash directly to shareholders. That handoff is a dividend. Sounds great, right? Free cash just landing in your account. Except here's the thing: it's not free. Nothing in investing is ever free. Think about it this way. Imagine you have a piggy bank worth $100. You crack it open and take out $5. Now your piggy bank is worth $95. You didn't create $5 out of thin air, you just moved it from one pocket to another. That's literally what a dividend is. The company's value drops by the amount it pays out. Your stock price adjusts down. You didn't gain anything new, you just received a portion of what you already owned. Now, a lot of finance YouTube will skip right over this and go straight to "dividends are amazing, passive income forever." But if you don't understand this foundation, you'll make really bad decisions. Here's a real-world example. Let's say you own 100 shares of a stock at $50 each. That's $5,000. The company declares a $1 dividend. On the day that dividend gets paid out, the stock price typically drops by about $1, so now it's $49. You get $100 in cash. But your 100 shares are now worth $4,900. Total. Still $5,000. Nothing changed. You didn't get richer. You just liquefied a tiny piece of what you already owned. Now, does that mean dividends are useless? Absolutely not. But it means the dividend itself is not the point. The point is what's underneath it. Is the company strong enough that its stock price will recover and grow over time? Is the business actually healthy? Is that cash payout sustainable long-term? That's where most people stop asking questions, and that's exactly where they get burned. Alright, here's where we get into the stuff that Gary from Ohio wished someone had told him. There are 3 massive traps that catch everyday investors chasing dividend income. And at least one of these has probably already crossed your radar. Trap number 1, the yield trap. This is the big one. You're scrolling through a stock screener, looking for dividend income, and you see it, a stock with a 12% dividend yield. Maybe even 15%. Your eyes light up. You're thinking, if I put $50,000 in there, that's $6,000 a year doing nothing. That's $500 a month just showing up. Stop right there. A high yield like that is almost always a red flag, not a green light. Here's why: dividend yield is just the annual dividend divided by the stock price. So when a company's stock price falls, because the business is struggling, the yield goes up automatically. It looks more attractive the worse things get. It's like seeing a house listed at $50,000 in a neighborhood where every other house is $300,000. Sure, it's cheap. But why is it cheap? Companies with 12, 15, even 20% yields are usually in serious trouble. The market is basically screaming, "We don't think this dividend is going to last." And when the dividend finally gets cut, and it usually does, the stock drops another 20, 30, sometimes 40% in a single day. You lose the income and the value. Double hit. A sustainable dividend yield for most healthy companies sits somewhere between 1.5% and 4.5%. Anything significantly above that deserves serious scrutiny before you put $1 in. Trap number 2. Confusing dividend history with dividend safety. Here's another one that gets people. They look up a company, they see it's paid a dividend for 25 years straight, and they assume it's rock solid. 25 years, that thing's bulletproof. No. Past dividends are not a guarantee of future dividends. Full stop. General Electric paid dividends for over a century. They were considered one of the safest blue-chip stocks in America. In 2018, they slashed their dividend to just 1 penny per share. Stock tanked. Retirees who had built their income strategy around GE got absolutely wrecked. History matters. But it has to be paired with looking at the current business. What does the cash flow look like right now? Is the revenue growing or declining? How much debt are they carrying? What's the payout ratio? That's the percentage of earnings being paid out as dividends. If a company is paying out 90 or 100% of its earnings as dividends, there's almost no cushion. One bad quarter and they're cutting it. Trap number 3, letting dividends blind you to a bad stock. This one might be the sneakiest trap of all. It's called the dividend anchor bias, and it goes like this: you buy a stock for its dividend. The stock starts going down. But the dividend is still coming in every quarter. So you hold. You tell yourself, "I'm still getting paid, so it's fine." Meanwhile, the stock drops 30%, 40%, 50%. You didn't lose money, you tell yourself. You're collecting income. But here's the math check: if your stock dropped 40% and you collected 3% in dividends, you're still down 37%. The dividend did not save you. It just made you feel better about a bad investment while the damage piled up. Don't let a quarterly check stop you from thinking clearly about whether a stock is actually worth holding. Okay, we've talked about the traps. Now let's flip it, because dividend investing, done right, is genuinely powerful. Here's where it actually works. Benefit number 1, dividend growth stocks can build serious wealth. There's a big difference between chasing the highest yield and investing in companies that consistently grow their dividend year after year. These are businesses that increase their payout by 5, 8, 10% annually, not because they have to, but because their earnings keep growing and they're rewarding shareholders along the way. Think about what happens when you reinvest those growing dividends back into more shares. Your share count grows. Your dividends grow. Your dividends buy more shares. Those shares generate more dividends. It's a compounding snowball, and over 20 or 30 years, it becomes genuinely life-changing money. Here's a way to think about it. Imagine you plant an apple tree. Year 1, you get 10 apples. You plant the seeds from 2 of them. Year 2, you have more trees, more apples. You keep planting. By year 20, you've got an orchard. That's dividend reinvestment. You're not just collecting, you're building. Benefit number 2, dividends force companies to stay disciplined. This one's underrated. When a company commits to paying a regular dividend, it creates accountability. Management can't just blow cash on bad acquisitions or vanity projects, because they know they have to write that check every quarter. It creates a culture of financial discipline that often filters down to better decisions overall. Studies have shown that companies with strong, growing dividend histories tend to be better managed, have cleaner balance sheets, and deliver stronger long-term returns, not just income. You're not just buying a payout. You're buying a type of company culture. Benefit number 3, dividends are incredible in retirement. If structured right, if you're in or approaching retirement, dividend income has one massive advantage over just selling shares: you don't have to touch your principal. Think about a retiree with $600,000 in a dividend growth portfolio generating 3% in annual income. That's $18,000 a year coming in without selling a single share. The portfolio can still grow. It can still compound. And psychologically, there's something powerful about having income show up rather than having to manually sell assets, especially during a volatile market when selling feels like bleeding out. This isn't magic, it requires careful stock selection, diversification, and not chasing yield. But for the right person with the right timeline, it's a genuinely elegant strategy. Let's address the elephant in the room: the online war between dividend investors and growth investors. Both camps act like the other one is crazy. Both camps are wrong about being 100% right. Here's the honest truth. Dividend investing and growth investing are tools. Not religions. Not identities. Tools. And the right tool depends on your situation. If you're 25 years old with 40 years until retirement, putting all your money into slow-moving dividend stocks is probably leaving a lot of money on the table. Growth stocks, even ones that pay zero dividends, can outperform significantly over long time horizons when you're reinvesting and compounding. You want growth. Time is your biggest asset. If you're 58 and building toward retirement in 7 years, a portfolio with strong dividend growers starts making a lot more sense. You want stability. You want income that doesn't require selling. You want companies that have proven they can weather recessions. And here's the nuanced middle ground nobody talks about: you can do both. A portfolio that's 60% solid dividend growth stocks and 40% high-quality growth names isn't a contradiction, it's balance. You get income, compounding, stability, and upside. The people losing money are the ones who treat dividend investing as a personality, who hold garbage stocks just because they pay a check, or who are so obsessed with yield they ignore everything else about the business. One more thing on this: don't overlook share buybacks as the inferior option to dividends. When a great company uses profits to buy back its own shares, it's reducing how many shares exist, which means your piece of the pie gets bigger, quietly, without you paying taxes on it until you sell. In many situations, buybacks are actually more efficient than dividends from a pure math perspective. Neither is automatically better. Context is everything. Alright, let's bring this all together with something you can actually use. If you're going to invest in dividend stocks, here's a simple checklist before you put a single dollar in. Step 1, check the payout ratio. This tells you what percentage of earnings the company is paying out as dividends. Under 60% is generally healthy. Above 80%, proceed with serious caution. If it's over 100%, they're literally paying out more than they earn. That dividend is on borrowed time. Step 2, look at free cash flow, not just earnings. Earnings can be manipulated by accounting tricks. Free cash flow is harder to fake. Make sure the company actually has real cash coming in to support that dividend. You want free cash flow to comfortably cover the dividend. Step 3, check the dividend growth history, but also the recent trend. Has the dividend been growing consistently over the last 10 years? Great sign. But also, what happened in 2020? Did they cut during COVID, or did they hold? How a company handles stress tells you everything. Step 4, evaluate the business, not just the yield. Would you want to own this company even if it paid zero dividends? If the answer is no, the dividend is a disguise. You want to own great businesses that also happen to pay growing dividends, not mediocre businesses held together by yield bait. Step 5. Make sure it fits your goals. Are you 10 years from retirement and want income? Dividend growth stocks make sense. Are you 28 and building wealth aggressively? You might be better off with a blend. Don't buy dividend stocks because someone on YouTube made it sound cozy. Buy them because they fit where you are headed. Look, dividend investing isn't a scam, and it's not a magic bullet either. It's a strategy. And like any strategy, it only works when you understand it clearly, use it intentionally, and refuse to fall for the traps. The best thing you can do right now. Take one dividend stock you own, or one you've been watching, and run it through that checklist we just covered. Payout ratio. Free cash flow. Dividend growth history. Business quality. Does it fit your goals? If you can't answer those 5 things confidently, you're guessing. And guessing with your money is how Gary ends up at that kitchen table. If this video helped you think about dividends differently, drop a comment below. I read every single one and it helps me make better content for you. And if you want to go deeper on building a portfolio that actually works for your life, subscribe and hit the bell. New video every week. I'll see you in the next one.